Many traders correctly read direction, yet still lose money because their entries are mistimed. In this video, I will show you where entries should actually be taken using the same weekly candle approach. The weekly candle acts as your primary reference for higher time frame analysis. It defines the most important levels the market responds to and highlights where liquidity sits above and below price. The high of the candle represents upside liquidity, while the low represents downside liquidity. These are the areas where larger participants are active. When you use the weekly candle as your anchor, you filter out lower time frame noise and allow price to travel toward these liquidity zones before making decisions. Traders lose consistency when they ignore this context and act too early, instead of waiting for price to clearly show its intention. Hello and welcome back to another video here on the ComLucro channel. In this video, we focus on how precise entries are built using the weekly candle as a higher time frame reference, and how price moves from context into execution before the move becomes obvious. You will learn why direction and entry must be treated as separate decisions. We also cover how liquidity sweeps, change of character, and change in state of delivery fit into this process, and how CISD helps align entries with momentum after liquidity is cleared. Together, these concepts create a clear framework that improves timing and risk to reward while staying aligned with liquidity and market structure. So if you enjoyed this video, make sure to like it, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we go deeper into execution, there is a key concept you need to understand. Most traders look for confirmation in structure, but the real shift in the market often happens before structure clearly breaks. This next clip explains how price transitions from control into execution, and why understanding this process can dramatically improve timing and risk to reward. Pay close attention, and if this concept clicks, make sure to watch the full video later. Most traders look for confirmation in structure, but the real shift in the market often happens before structure clearly breaks. If you understand how price transitions from control to execution, you can spot reversals earlier and enter with much better risk to reward. That is where the difference between change of character and change in state of delivery becomes critical. These two concepts explain not just where price breaks, but how momentum and control actually change behind the scenes. A change of character occurs when price begins to lose its previous structural control inside a broader swing. This process usually starts from a deeper pullback of the prior move, where price retraces 50% or even deeper of the swing. From this pullback, price develops a more complex movement, with both the expansion and the retracement containing several candles. This reflects a gradual transition phase, where control is weakening, but price delivery is still inefficient. The key role of the change of character is structure, not speed. It highlights that the prior directional bias is no longer dominant. A change in state of delivery focuses on how price is delivered rather than on structure itself. CISD typically appears after a liquidity sweep and is characterized by a sharp and efficient expansion, preceded by a short and shallow retracement, often around the 38.2% level. Both the expansion and the pullback usually involve very few candles. This reflects a sudden shift in momentum, where price moves with clear intent and efficiency. CISD signals that the market has transitioned from distribution or accumulation into active execution. In practical terms, CISD often appears before full structural confirmation. It provides an early indication that a reversal may be unfolding, especially when it occurs immediately after liquidity has been cleared from one side of the market. When combined with concepts such as liquidity sweeps and fair value gaps, CISD improves trade quality by aligning entries with momentum and institutional price delivery. Understanding the distinction between change of character and change in state of delivery allows you to read market transitions with greater precision. While change of character highlights structural weakening through slower and deeper movements, CISD confirms that price has shifted into an efficient and directional state. Using both concepts together helps refine entries, improve timing, and achieve better risk-to-reward conditions in high-quality trade setups. With that context established, this is how price reacts around a weekly candle. The previous week's high and low act as liquidity magnets that attract price. Price will either fail to displace these levels, signaling a potential reversal, or it will displace beyond them, signaling continuation. That reaction reveals direction, not the entry itself. In practice, the weekly candle frames how price interacts with liquidity. The prior week's high and low draw price toward them, where either rejection or displacement occurs. That outcome determines directional bias, while the entry is handled later through execution rules. First, identify the weekly reference points. This step is straightforward. Mark the previous week's high and low. Nothing more is needed. Next, wait for either a liquidity sweep or a failure to displace. Do not take any action until price reacts at these levels. You're looking for a clear sweep or a clear failure to displace in this area. Most false moves happen before this reaction. This step requires patience and manual marking, allowing you to read price behavior directly. Finally, execute using the CISD. Move down to your execution time frame, whether that is the 15-minute, the 5-minute, or the 1 hour. The entry remains simple. Either trade the break of the CISD or the inversion of the fair value gap. That is the trigger. There is no guessing involved. Let me walk you through this directly on the charts so you can see how it works in practice. Here we are on the weekly time frame. The first thing you want to do is mark the high and the low of the weekly candle. After that is done, move into a higher execution context. Once the weekly highs and lows are marked, I usually drop down to the 4-hour time frame. This makes it much easier to observe the sweep behavior clearly. At this stage, the only thing we do is wait for price to reach the level. There's no action yet. We simply allow price to come into the weekly level and watch how it reacts. When price reaches the area, we are looking for a failure to displace. So we wait. Price reaches the level and the reaction begins to form. This is what a failure to displace looks like in real time. Price sweeps the previous week's high and then produces a 4-hour failure to displace. This is a strong reversal signal, and this is exactly what we want to see at a weekly high. After this failure to displace is confirmed, we wait for the candle to close and then move into the entry time frame. I prefer to execute on the 15-minute chart. Here on the 15-minute, you can clearly see where the sweep occurs. From here, the next step is to mark the CISD level, which is shown right here. The CISD is defined by the candle or group of candles responsible for creating the sweep. In this case, you can see the exact candles that swept the previous high. Next, we focus on the base of that structure. This becomes the key level that must break before we consider any entry. All we do now is wait. When price closes below this level, the condition is met. This confirms a valid break and close of the CISD, which is where entries are considered. The stop loss is placed above the recent swing high. If this truly is a manipulation point, price should not trade back above that level. That is why the stop sits above the previous swing high, while targets are set toward lower liquidity. Target selection depends on your risk tolerance and how long you prefer to hold the trade. One option is targeting these lower liquidity areas here. Another option is targeting these lows as well. A third option is simply targeting the weekly candle low, which sits at this level. Now, let us play it forward. If your take profit was set here, the trade would have closed successfully. Alternatively, partial profits could have been taken at that level. If the position was held longer, price would eventually move into the lower liquidity zone. Keep in mind that weekly highs and weekly lows act as magnetic levels. Price is naturally drawn to take out both highs and lows because that is where liquidity rests. In this case, you can see that the move lower takes a bit more time to develop. Eventually, price trades into the area and takes out the lows as well. This is the exact entry model you should be looking for when price reaches these key levels. This is the structure and sequence that confirms a high-quality setup. Before we wrap up, it is important to tie everything together. Throughout this video, the focus has been on understanding direction through the weekly candle, recognizing liquidity behavior, and identifying the moment when price transitions from context into execution. Structure and concepts like change of character provide the framework, but execution always depends on interacting with price at the right locations. Simply marking levels on a chart is not enough. The real challenge is knowing which zones are likely to be respected and which ones will be ignored. That is why fair value gaps and order blocks must always be evaluated through the lens of direction, structure, and liquidity. To make this clearer, I want to show you a short clip from another video where this process is broken down in detail. Pay attention to how price reacts across multiple time frames and why execution only works when it aligns with context. Let us take a look. So let us begin. As you already know, order blocks and fair value gaps are two zones that smart money traders rely on when setting their entries in the market. Still, many traders struggle to understand which of these areas carries the stronger probability and is more likely to be respected by price. In this example, the market reacts to the higher time frame order block, but ignores the lower time frame one. This reveals an important insight. When price repeatedly fails to reach your entry, it often means the setup has been refined more than necessary. Entries only work when they are aligned with direction, structure, and liquidity. When these elements are clear, it becomes much easier to judge whether price will react, continue deeper, or bypass a zone entirely. Traders who consistently align context with execution focus on higher probability setups and avoid losses caused by poor structure or unnecessary refinement. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.